So if you check on Twitter right now, you find that World Economics, this London-based economic research firm, just released its latest data on Nigeria's Sales Managers Index, and this is what you need to know in a very few seconds. It says Nigeria economy is experiencing headwinds on the road to recovery, and the Sales Managers Index data for the month of February we are in shows that the index is reading 48.5, but continue to be very close to the level that the analyst says separates growth from contraction. 50 is a healthy reading. Any figure below that is in the water. So Nigeria's Sales Managers Index, which measures growth across the country, paused in the month of February at 48.5, and the report says Nigeria's Market Growth Index ends a run of 4 consecutive months of rises. However, I will quote this, it says the economy remains in recession, but the managers or business managers are reporting renewed business confidence on the back of improving sales as represented by the Sales Growth Index, 47.7 from a low of 36.8 in October. Nigeria's conditions remain challenging, but business managers are experiencing optimism that the country will be out of its year-long recession within the next few months. That's what is out today, this afternoon from World Economics. But let's keep it at home here, where a dual listing of 9 billion naira bond by integrated energy trader 40 Oil PLC was done Tuesday on FMDQ OTC Securities Exchange and the Nigerian Stock Exchange. The listing was Series 1 of the 17.50% fixed rate unsecured debt under 40 Oil's 50 billion naira bond issuance program. For FMDQ OTC Securities Exchange, it was the first of such admittance in the new year 2017, attended by top officials of the energy company and other parties such as United Capital, the sponsor of the debt paper. Speaking briefly to the bond listing maturing year 2021 was 40 Oil's Chief Financial Officer, Julius Owotuga.
Like we always say at 40 Oil PLC, we're committed to transparency and full disclosure. Our reason for listing this bond is for our investors to have the opportunity for price discovery. So at any point you want to trade our shares, you know that you're trading at the right price. In addition to that, liquidity is of importance to us, and we believe that listing on FMDQ and Nigerian Stock Exchange will provide investors the required liquidity. So at any point you need to buy or sell it, you can always do that. So that's just basically it.
Into the bigger world of oil, Secretary General of the Organization of Petroleum Exporting Countries, Mohammed Bakindo, says the implementation of an agreement between OPEC and other major producers last November to reduce output has been, quote, very encouraging, end of quote, and that the agreement is on track to reduce the global oil surplus. According to Mr. Bakindo, it's premature to say whether OPEC would need to extend the agreement beyond its initial term of 6 months, which ends in June, or even to deepen the cuts. He maintains that the pace of the decline in global oil stockpiles, which OPEC wants to see fall back in line with the 5-year average, will determine the group's next move. Oil prices has held above $50 a barrel since OPEC and 11 other nations started trimming output. In January this year, the exporters group implemented about 90% of the pledge cuts last month, and Goldman Sachs predicts the market will shift into supply deficit in the first half of 2017, although U.S. crude stock prices have kept increasing to the highest level in more than 3 decades. Right now we're looking at crude around $54.05 per barrel. That's the U.S. NYMEX. That's down about 0.5% today. Still in the world of oil, Russia's state oil corporation Rosneft has posted a net profit of 52 billion rubles, or that's nearly $900 million for the fourth quarter of 2016, doubling Q3 figure. The oil giant recorded a revenue growth of 21.4% to 1.49 trillion rubles as the price of crude oil rises, and the company added production via the acquisition of PAO Bashneft. A Market Watch report on Wednesday says Russian oil firms such as Rosneft have been helped to wade through recent weak oil prices by a tax system that provides relief at lower prices, as well as the weakness of the local currency. Let's return to Africa, where Ghana's president, Nana Akufo-Addo, has taken power with ambitious plans to revive one spectacular economic growth that he says in the State of the Nation address on Tuesday is in a bad way. Mr. Akufo-Addo is faced with the tasks to show how he will deliver on his campaign promises with a $1.6 billion hole in the budget and a deficit twice as high as expected.
In his first major address since being sworn in on January the 7th, Akufo-Addo told Parliament that restoring macroeconomic stability was key to addressing the biggest problem facing the country, creating jobs, especially for young people. Ghana's economy was one of Africa's most dynamic, but it was hard hit starting in 2014 by a slump in global prices for its gold and oil exports.
I say nothing new or dramatic when I tell this House that the economy of our country is in a bad way. The debilitating and confidence-sapping problem that affects every home. We can argue on what the official rate of unemployment is, but we can all see the desperation of our young people. They want to work, but there are no jobs, and some of them are being driven to unacceptable behavior. We have a veritable time bomb on our hands.
A fiscal crisis saw inflation and the deficit rise and the currency fall. GDP growth for 2016 was estimated at 3.6%, the lowest level in some 23 years. Ghana started a 3-year program with the International Monetary Fund in April 2015 that aims to reduce inflation, the deficit and public debt, stabilize the currency and boost growth.
The wishes are there, the good intentions are there, but there's also a reality on the ground. So engaging labor, engaging the business community so that there is a better shared appreciation and understanding of where we are as a country is the first thing the government should do.
Akufo-Addo took office last month on pledges to spend the equivalent of $1 million a year on development of each of Ghana's 275 parliamentary constituencies. He also promised to cut taxes. His plan is to stimulate private sector investment to raise economic growth back into double digits from around 4% last year.
I know a government said that he's going to make a one district, one factory. These are just a source of work. It's something like a handicraft. We can make a factory for us. We need a government to come and help us for their work so that we can expand this work. We get a foreign market and a local market.
The new government must reveal in its first budget next month how it intends to restore financial discipline while staying true to Akufo-Addo's election promises to boost growth and fight poverty.
Finally, on Business Incorporated this Wednesday, Zambia's central bank has cut its benchmark lending rate by 150 basis points to 14%. Zambia's inflation slowed to 7.0% year-on-year in January from 7.5% last December. And that's about all on the program for today. We thank you for watching, everyone. I'll see you again.